Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, September 8th, and I'm recording this from my office in Purchase, New York. Most of the market action for the past month has centered on whether the Federal Reserve will cut rates at its meeting next week. Based on the current Fed funds futures market, there is now little debate. The probability of a 25 basis point cut is more than 99%. Combine that with the potential for stimulus in 2026 from the new tax law, and the Goldilocks reflation outlook prevails in the equity markets. While the strength of current corporate profits supports this bull case for stocks in the near term, we're concerned that markets are underpricing the longer-term risks, specifically the risk to Fed independence. Threats to Chair Powell's job have ended, but in the past few weeks, unprecedented attempts to fire a sitting Fed governor have heated up. The markets have shown little reaction, with the noteworthy exception of gold. Since August 19th, when the firing of the Fed governor was announced, the price of gold has risen more than 8% to an all-time record high. Gold has been rallying alongside stocks since October of 2022, and has even outperformed the U.S. stock market materially over that time, which is unusual for a risk-off asset. Many have suggested that gold's behavior is explained by global central banks buying more of it to diversify away from the U.S. dollar. But we have long wondered whether it also reflects hedging by investors against the bigger challenges to markets: unsustainable debt levels around the world, and the potential for extremes of both inflation and deflation, and now the risks that politics becomes the primary driver of Fed policy. For the U.S., central bank independence has been a crown jewel, supporting the dollar's status as the world's reserve currency. We see it as critical to the long-term outlook and to the risk premia in markets. It is easy to envision why White House policymakers would want to press for lower interest rates. Lower rates could stimulate the economy by energizing the credit supply and help the U.S. Treasury manage the interest expense on $36 trillion in debt. However, there are longer-term risks. Policy that's too easy could lead to much higher inflation, a weaker and debased currency, and a misallocation of capital, similar to what we saw during the housing boom before the great financial crisis. And more broadly, when monetary policy making becomes politicized, it can undermine the credibility of the government on different levels, including government data, which affects investors' ability to make long-run forecasts for corporate earnings, their cash flows, and valuations. As we see it, the gold market is sending a message that the risk to Fed independence is real. Traders may rejoice in the short term at the prospect of easier money, but longer term investors focused on wealth preservation and purchasing power should pay attention to value. Consider selling small caps and non-profitable tech companies, as well as popular but low-quality meme stocks. We also suggest being highly selective in consumer-oriented names while adding real assets to passive U.S. equity portfolios and actively selecting U.S. large-cap quality stocks. Our other recommendations include intermediate duration investment-grade bonds, including municipals, international equities, including emerging markets, and hedge funds and private secondaries. Finally, in private credit, we favor asset-backed lending and distressed securities. Thanks as always for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.